Now we move into the cash budget. The cash budget is one of the most important budgets because a business can be profitable on paper but still fail if it runs out of cash. The cash budget summarizes cash inflows or cash receipts, cash outflows or cash disbursements, and the ending cash balance. The cash budget helps managers ensure the company maintains adequate liquidity. To compute cash receipts, we must start with budgeted sales. In the Bob Willis example, if you link back to your sales budget, you'll see we start with total expected sales of $200,000, $240,000, $320,000, and $200,000 for each quarter. We then have to use some assumptions on collection patterns. In this example, we assume that 85% of sales are collected in the quarter that they are sold. Then 13% of sales are collected in the following quarter. 2% go uncollectible because sometimes customers don't pay if we sell on account. You can see that the first quarter's receipts include sales from the previous quarter plus sales from the current quarter to arrive at total cash receipts. Now let's move to Learning Activity 914 and develop a cash receipts budget for Amore Artisan Hair Accessories. Collection assumptions in this case assume that 50% of sales are collected in the same month of the sale, 48% are collected in the following month, and 2% go uncollectible. Use monthly sales data from Learning Activity 9.3. Now let's compute our first computation for cash disbursements, and that's cash disbursements for raw material purchases. In the Bob Willis example, we're going to start with raw material purchases and then use some assumptions on our payment patterns to estimate the actual cash disbursements for those purchases. We estimate that we pay 90% of our purchases that were on account in the quarter that we made the purchase. We estimate that we make 10% of the payments in a following quarter as those payments are delayed. We generally don't assume that we're not going to pay some of our purchases. So in this case, our cash disbursements for the first quarter are $66,541, which are payments on the current quarter's purchases and payments from the prior quarter purchases, which is information we'll have to get. If you look at the second quarter, we have payments for the second quarter's purchases and payments of 10% on the first quarter's purchases. Now let's complete Learning Activity 915 and compute cash disbursements for raw material purchases for artisan hair accessories. We'll use the following assumptions: that current purchases, 55% are paid immediately, and for remaining purchases, 45% are paid in the following month. Pause here and complete your computation of cash disbursements for purchases for artisan hair accessories. For other cash disbursements, we generally assume they are paid in the period they are incurred. Those include cash disbursements for direct labor, manufacturing overhead, selling and administrative, and any other expenses. We can take those cash disbursements directly off of the budgets for labor, overhead, selling, and administrative. One thing to remember, if there are any depreciation charges on those budgets, you'll need to back that out because depreciation charges are non-cash expenses, and we're aiming to arrive at cash flow on the cash budget. Now do Learning Activity 916. Develop a cash budget for Amore Artisan Hair Accessories. That includes data from the labor budget, the overhead budget, and the selling administrative expense budgets. Remember, depreciation is not a cash expense, so it must be removed from cash disbursements. Pause here and complete the total cash disbursements and check your answer with the solution provided in the back of Chapter 9. The cash budget summary is a computation that tallies the previous budgets that we just computed. It includes the cash receipts, the cash disbursements for material and other cash disbursements. We net those together to arrive at a change in cash balance, in this case for the respective quarters for the Bob Willis example. We add to that the beginning cash balance to arrive at ending cash. Let's do that in Learning Activity 9:17 for a more artisan hair accessories. The beginning cash balance is $6,150. Now use the receipts from Learning Activity 9:14, cash disbursements from 9:15, and 9:16 to compute the ending cash balance. Pause here and check your solution with the answers provided in the back of Chapter 9. Now the projected income statement. The projected income statement summarizes expected revenues and expenses for the period. It includes sales revenue minus cost of goods sold, which equals gross margin, and then minus the selling and administrative expenses to arrive at net income. The projected income statement provides an estimate of profitability, and we pull that data directly from the previous budgets that we've already computed. Let's look at it in detail for Bob Willis. The sales revenue comes directly off the sales budget. Bad debts, on the other hand, is something new. Bad debts is derived as 2% of total sales that we expect to not collect. That came from our cash budget. That arrives at net sales. From net sales, we subtract cost of goods sold, selling and administrative expenses, and ultimately arrive at net income. Now complete Learning Activity 9:18. Prepare a budgeted income statement for a more artisan hair accessories using the sales budget, the cost of goods sold budget, and the selling and administrative expense budget. Pause here and compute the projected net income. Check your answer with the solution provided in the back of Chapter 9. Now we move into the projected balance sheet. The projected balance sheet shows the company's expected financial position at the end of the budget period. Key items include cash, taken directly from the cash budget. Accounts receivable starts with the beginning accounts receivable balance plus net sales minus cash receipts. Inventory is taken from the cost of goods sold budget. Accounts payable comes from the beginning balance of accounts payable plus purchases minus cash disbursements. And equity, which is beginning equity plus net income. The projected balance sheet ties it all together, but it can sometimes be difficult to balance. You should write down projected balance sheet uses a cash budget, accounts receivable collections, and inventory budgets, and net income. Let's take a look at the detailed data for Bob Willis. If you look, the cash ending balances for each quarter on the balance sheet match the ending balance on your previous cash budgets that you already computed. The accounts receivable balance is computed by taking the beginning balance from the previous quarter, adding net sales and subtracting net receipts for that particular period. Inventory is taken straight off the cost of goods sold budget. Accounts payable is computed by taking the beginning balances plus purchases minus cash disbursements for materials back from your cash budget. And then equity. If you take the beginning equity, add the net income from the income statement that we just computed, you will arrive at the appropriate owner's equity. Should also note that the accumulated depreciation is increased by the depreciation from your previous expense budgets. Also on this example, we did not budget for property, plant, and equipment or capital budgets, so that didn't change across quarters. Now complete the Learning Activity 9:19. Prepare the projected balance sheet for January for a more artisan hair accessories. You'll need beginning balances for all items on the balance sheet. You'll also need cash budget results, sales budgets, and depreciation information. Pause here and complete the balance sheet. Once you've finished, check your answer with the solution provided in the back of Chapter 9. Let's take a look at the solution for 9:19. The January's cash balance can be taken directly from the cash budget. Accounts receivable starts with the beginning receivables, which was 0. Add net sales from your sales budget and cash receipts. Ending raw material, work in process, and finished goods are computed by taking data from your cost of goods sold budget. The January depreciation can be computed by taking information from the overhead budget. Your accounts payable consists of your beginning payable balance plus your raw material purchases minus cash disbursements for raw material. And finally, your ending equity is computed by taking your beginning equity, adding to it net income, and you would arrive at your ending equity balance.